Welcome. Today, we're going to share with you some of the events that are currently driving the markets. Also, share our thoughts on what happened in the second quarter and what investors should be aware of as we head into the second half of 2021. Plus, I want to talk about some ideas and strategies that you should have on your mind as we look forward into the second half of the year. You see, as vaccines continue to roll out through the second quarter, the economy and markets grew as the country slowly reopened. But the question that's on everybody's mind is, can the momentum from the first and second quarter continue throughout the remainder of the year? Now, before we dive in, a few notices here from our compliance department. If you'd please take a brief moment to read through this slide. Also, for those that I haven't met, I'm Scott with Sierens Financial Group, where we help people answer their key questions. Are you on track for retirement? What can you do to improve your financial picture? And how can we help reduce your overall tax situation? Now, one of the key parts of compliance is just really understanding that, hey, past performance does not or is not indicative of future results. With that, let's dive in. Well, in the second quarter, markets continued the growth that we saw in the first quarter. Here's a graph of the Dow Jones Industrial Average for the second quarter. As you can see, there was multiple times throughout the second quarter where the Dow Jones hit a new high. And it reached a peak of actually 34,750 before just dropping right back down under 34,000. But again, looking at the second quarter in total, right, from left to right, we see that overall the markets had growth throughout that quarter. So what do we think are some of the reasons behind the growth in the second quarter? Well, vaccines became widely available to all Americans throughout the second quarter. States that were really hardly hit by the virus, like California and New York, were finally able to reopen as more people were vaccinated. As you can see in the chart here, over 150 million people were vaccinated. People felt a little bit more comfortable now getting back out into their daily lifestyles, into what they were doing prior to the COVID vaccine. So things started to reopen and the economy started to boom a little bit. Another thing that might be driving some of these results is the unemployment rates. I mean, take a look at this. From May of 2020 to May of 2021, a drop in unemployment rates from 13.3% to 5.8%. Also, we've hit a record of 9.3 million job openings in that second quarter. But one thing to be aware with that is that a lot of business owners are actually reporting that they're having a hard time finding workers. So things are, again, continuing to open up, more jobs available, and actually a shortage right now of workers out in the economy. Another indicator that we look at is the weekly unemployment rates. And I look at this as a positive chart, a positive for all of us to see, in that the weekly unemployment rates continue to decline, and they significantly declined throughout the second quarter. I also feel that this rate will most likely continue to decline throughout the year as the federal unemployment benefits that have been offered throughout COVID will end at different points throughout this summer. Now, one thing to be aware of is that prices are going up, and I'm sure you've seen that, whether it be from just going out to dinner in regards to overall gas prices. But here's the deal. Americans have been spending that money that they received as stimulus throughout the lockdown. So as a result, demand is up, and our supply chains are really still struggling to regain full capacity. So right now, we're starting to pay more for everything, whether it be from food to lumber for renovations or new houses, and then gas for our cars. And all of that means, what that means is that we're starting to see a little bit of inflation in our economy. So what should we be looking out for in the second half of 2021? Even though the second quarter was strong, right? We saw growth throughout the second quarter. Jobs and inflation still remain some weak spots that we need to watch. And right now, there's not really anything positive for the markets to be looking forward to. So any news, whether it be good or bad, could create some volatility in the markets. And it's very, very helpful to be aware of that. So, what is volatility? Well, volatility are those swings, those up and down swings in the market. Now, here's a look at the VIX, and what the VIX is the VIX is the measure of the level or the amount of volatility in the market. So, as you can see, in when COVID first hit, right, the VIX was at a pretty high level. There's a lot of volatility in the markets because there was a lot of unknown. And right now, or kind of, towards the end of the second quarter, the VIX was at a pretty, not a, it was at a lower level, of course, a way lower level than what we were seeing a year ago. So, what causes this volatility, or what could potentially cause it? Well, negative reports on things like unemployment, inflation, or policy errors could lead to an increase in the volatility in the markets, or those up and down swings. And as we continue to, see what's happening with the COVID, as we continue to see what happens with new jobs, with inflation, so as different reports come out, we could potentially be seeing some swings in the market, as it really is not certain on what to look forward to right now. So, looking forward into third quarter, what's the best course of action that you can take right now? Well, one thing to do is stay vigilant. You see, this pandemic is going to continue to be a factor in the third quarter and actually throughout the rest of the year, especially as we learn about new variants, and then whether or not, vaccines will provide protection against these new variants. So stay vigilant. Also inflation concerns, as I just mentioned earlier, could be some things that cause some volatility, or maybe even both of these items, or maybe even things that could, depending on what kind of news comes out, could potentially set the markets back. Or if there's good news that that we can continue to reopen as we have, they could continue to send the market forward. So we just have to continue to make sure that we've got the right balance. And I'll talk about that in a little bit here. So, one of my responsibilities is to continue to look at all situations and provide guidance through ideas and strategies. One of the things that I recommend to continue to watch is Congress and their decisions around the Biden tax plan. Having a tax plan in place could really help keep more of your hard earned retirement savings with you versus giving it to the IRS in taxes. So, part of our process in our year-end planning and tax strategy meeting, which is around October, we're going to discuss the potential actions that you can take to put yourself in the best position possible before the end of the year. Another strategy that we continue to keep our eye on is the balance in the portfolio, making sure that it's continuing to align not only with your risk tolerance, but with your income plan, how much income that you may need to withdraw from your portfolio in the upcoming years. And then having that right balance between how much you should have on the growth side, and then how much you should have in your war chest, or that safer side of your portfolios. This also becomes even more important as interest rates continue to remain low. So, although markets are soaring, last year's market drop can continue to be a painful reminder that things can shift really quickly. So, I encourage you to think back to that drop. And if that caused too much pain or too much anxiety or fear for you, then that's a time to say, hey, do we continue to have the right balance, or go back and take a look at the balance that we have in the portfolio and make any adjustments to your plan that you feel necessary. Remember, I'm always here to answer any questions that you have about your plan or your investments. Thanks, and have a great day.